zakat work, you generally are paying zakat on unproductive assets. You're paying on cash, you're paying on inventory. You don't necessarily pay 100% of the value if that money was invested in a business or in other aspects. So the point is that if you are participating in the economy in a fair way, and in a way that you take a risk, that's your responsibility, like that's your amana, and that is fulfilling the purpose of the money. But if it's just being kept in a bank account, then Allah subhanahu wa ta'ala is going to force you to provide some benefit to the community through zakat. So the meta point is that there's nothing wrong with wealth in Islam. It's that riba has created a system where wealth is made with no risk taken, right? Like a debt function. When someone gives you a mortgage, they don't take any risk for the house. They don't care if you bought the house in the swampland of Florida. It doesn't matter to them. They're always going to get their money back, and if the house gets destroyed, they still are owed their money back, right? And so what we need to think about when creating a system that is not riba based is something that can reward people, but there's also risk basically involved in that reward. So I think when a lot of people think about Islamic finance, they've seen kind of the existing solutions and they're very skeptical about it. And one of the reasons why that's the case is that it's been mostly in contract form, but not necessarily in substance, right? So people see that, there might be a different contract, or there might be something called a profit rate, but in reality, it looks pretty similar to interest, and sometimes it's even more than like an interest rate, for example, right? And I think the community has been not very pleased with those solutions that have existed today, right? And it's not me saying that. I think it's like a general consensus feeling that people have. And so when we started to think about NIA, which basically provides a home financing solution for homeowners and also provides an investment vehicle, it's to think about the community called for genuine risk sharing. If you're going to provide capital to someone, you need to take a risk. It can't just be a debt instrument. You have to participate in the gain and the potential loss, and something that feels authentic, that's a real partnership between the people that are providing the capital and the people that are needing the capital to help them basically buy a house, right? And so the model that we really strive to create is a model of partnership rather than a debt holder and someone who gives debt. So we don't even actually have a concept of a lien or a mortgage in our model. It's actually two people co-owning a house together. So I kind of talked about earlier about the home ownership gap, and that's kind of the reason why we started NIA. But what we've basically been able to do is show one of the first of its kinds models where homeowners and investors can own a home together, debt-free. And I'll walk through a little bit of how that works. Again, the purpose is just a show of it is possible to create an alternative system, and this is just like one example to do it, and there's other forms that can be potentially done. So the way it works in our model, and there's some other models that are very similar to ours. There's a co-op called Amin Housing in California. There's a co-op in Toronto called Ansar Co-op. What basically happens is the homeowner and NIA, backed by investors in the community, come together. So let's say the homeowner puts 20% down, and they're buying a $500,000 house. So they're putting 100K down. NIA puts 400K down. They put 80%, and the homeowner rents the home from NIA. Now, they technically own 20% of the home, so they're only going to be renting 80% of the home. That's NIA's share from NIA. Now, the first question that's going to be asked is like, what's the rent payment? Is it based off of interest rates? No, it's not based off of interest rates. It's based off of whatever the market rent is for the house. So the government actually publishes data for every zip code, for every bedroom in a zip code, what the average rent is on a quarterly basis. It's called fair market rent value. That's what we use. So in Marietta, like let's say a 3-bedroom house is $4,000. That's what would be the rent. and then 80% of that would be the rent that someone owes. Then the homeowner is responsible for their portion of insurance, taxes, and major expenses like roof, HVAC, whatever. So if they own 20%, they're going to pay 20% insurance, 20% tax, 20% major expenses. Nia is going to pay 80% insurance, 80% tax insurance. We are participating in the actual expenses and maintenance of the home. And then what happens is the homeowner can rent, and then they can buy equity from us at whatever the market value is. So we reassess the house value on an annual basis. We have some caps so it doesn't become too fleeting to the homeowner, but also actually similarly, the government actually publishes some data of something called the HPI Housing Pricing Index, which is where home prices in a particular metropolitan area moved up or down. So that's kind of what we use to assess the value of a home. So let's say the home was $100,000 and now it went to $105,000 and someone bought 10%, they would be buying $10,000 of equity for $10,500. So that $500 gets distributed as profit to the investors, and then the homeowner owns another 10%. And when that happens, their rent actually goes down, right, because they own more of the house, but their insurance and taxes on the other portion increases. So at the end, what we want is the homeowner to own the entire property and Nia to eventually exit. And we just actually last month had our first homeowner completely purchase their house in full, and the Nia was removed basically from the house. So just to summarize, like what we're really doing is helping people buy a house. We're participating in the gain or the loss, right? Like I mentioned, there's no lien or mortgage. So if the property goes from 500K to 400K, and we sell and the homeowner and Nia agree to sell the property, then we will bear, and we own 80%, we're going to take 80% of only 400K. In a traditional mortgage, you are responsible for like whatever the loan amount was, you have to pay them back whether the house price is up or down, right? So it's fundamentally not a loan structure. We're participating in the upkeep of the house, insurance, tax, roof, HVAC, all major repairs. There's no late fees. There's no selling to Freddie Mae, Fannie Mac, because the people that have provided the capital are investors from the community, and they're benefiting from that. They're getting rental income from the rent that the homeowner pays, and they're also getting some appreciation. There's also no foreclosures. So this is an important point, is that in the traditional debt model, let's say you can't pay your rent for 3 months, bank takes over the house, they sell it, they get everything from the house. If you had 50% equity, you get nothing actually out of that. In our model, let's say you're not able to pay for a few months, we'll give you up to 3 months, then we'll deduct that from your equity. Let's say you own 20%, and then whatever the value the house sells for, you get your, let's say, 20% minus whatever rent that you owe. So you actually are able to keep your equity versus any other model out there. I think Nabil was mentioning Sheikh Umar Khan. He's our Sharia advisor. He's on the board of Fiqh Council of North America, and he's worked very closely with us to design this model from the ground up and has been a tremendous resource. I'll just touch on a couple more points to show like the progress that we've made with the help of the community. And it's just like I would like to show that when we can strive towards building an alternative system, we can do it. It takes time, it takes effort. We don't have a free money printer from Freddie Mae, Fannie Mac, but it is something that can be done. So we bought our first home in April 2023 in Dallas. These slides are a little bit old, but today we have 50 homes across 17 different states. Everywhere, I think we already have 3 homes in Atlanta, actually. We have them in Texas, Denver, New Jersey, kind of all across the map. And we're growing, alhamdulillah, at about 15 homes per quarter. So we've raised about 16 million from the community, and we're typically raising around like 2 to 3 million a quarter, and that enables us to buy about 10 to 15 more homes and help people. So that's the good news. The bad news is that, where is it? Okay, I'll come to the bad news. we cross about 100 investors across about 17 different states. And yeah, one of the forms of the bad news is that we have, this is actually outdated, we have 3,000 people on our wait list to buy a home with NIA. So that's with no marketing in the last 2 years, basically, from publicly launching. So there's obviously a significant demand from the community for this type of authentic model. And we are making progress towards there, not as fast as the community would like us to, obviously, but it is something that we're striving for. So the way that we actually prioritize our wait list is in 3 forms. One is if you need less than 400,000 from us. So you could be buying a 500K house, you're putting $100,000 down, NIA is putting up to $400,000 down, so you automatically get prioritized with that. Number 2 is if you're in a priority market for us. So we analyze all of the inventory across the United States. That's often housing inventory. That's often a precursor for kind of like where home prices go up or down. So Atlanta is kind of like I would say it's in kind of the middle of the market. Dallas and Denver have a lot of supply of homes, so they're kind of flat or declining. The Northeast and even Chicago is going up significantly because of the lack of housing supply. But Atlanta is generally a target market for us, and we have been able to buy, I think, 2 or 3 homes in the last 6 months here, alhamdulillah. I was going to cover one more thing. Yeah, we talked about the prioritization, we talked about the key markets. So I'll just touch on one last part, and then we can go to Q&A, is one of the common questions I get is like, why would like an investor want to invest in something like NIA? And subhanAllah, it's like I bring up this point to show why like the halal way is the better way. So before starting NIA, my father and I, we actually had about 100 homes in the suburbs of Michigan via like a fund model as well. But it was just like a traditional landlord and tenant. And every like 18 to 24 months, a tenant would leave, have to change the carpet, the paint. It would take another 3 months to get a tenant in. It was like the most horrific experience. I never wanted to do it again. It took me almost 14 months just to sell the 100 homes that we had after like the fund life cycle ended. Alhamdulillah, we did good, like we met all the rental returns, but it was such a painful experience that I never wanted to do it again. This model is very unique, where it is like having a dream tenant of a rental property, because your tenant is also a co-owner of the property. They own at least 20% of the house, and they're renting it from you, and they're a long-term renter from you. And the way that they take care of the home is going to be fundamentally different than any tenant would, because it's their house, right? They own part of the house. So there's no tenant turnover. They share in the major expenses. They take care of like the really minor expenses. And so actually like the halal way is better, not only for the resident, but it's actually also better for the investor, right? And this is what I'm talking about when I say like we can create a better model for everybody involved. It doesn't have to be like this existing riba-based system that we see that really strangleholds the people who are trying to be able to afford and buy a home in a proper manner. And yeah, I think truly like as the model that we have created is a genuine partnership. It's a musharaka-based model between the homeowners and the investors at the end of the day. I think I'll stop there. If you want to learn more about the investment part, you can just come talk to me after about that. But yeah, I'll pause there for any questions that anybody has. Yeah, so the question is, how many tenants have been able to purchase 100% of the equity back from the investors? So we've only been around for 3 years, but we really started scaling 2 years ago. We've had one so far that has purchased completely. The way that our model works is that you can buy 10% of the home, up to 10% of the home, year 1, year 2, like every year basically. But if you want to buy us out completely after year 3, you can do that in one shot. The reason why we have those 10% things is that we will participate if the value goes up or down. So let's say we bought the house at 100K, let's say it goes down to 95K based off of that assessment. We will still be obligated to sell you 10% of the house at the slight loss, right? So by kind of staggering it out, we obviously are analyzing the housing market and saying that in the long run, we think that this house is going to appreciate over time. So that's why we put those 10%. But after year 3, if you wanted to buy us out completely, you can. The other interesting thing I will note is that not necessarily by design, but our average down payment is around 50%. And some of the people even have put like 80 or 90% down, and they just need that last 10% because they've been saving cash their entire life to buy a home completely, and then they found us, and then it kind of accelerated their timeline to buy a home. Yeah, so the question was, let's say after 3 years they want to buy us out, will it be at the market value? Yes. Like, so through the HPI data that I kind of talked about, the housing pricing index, it went from 100,000 to let's say 110,000. They would buy us out at that value, and then they get 100% ownership of the deed, and they can move on. So there's two questions. One is, how long does it take to pay off the house? And then the second question was, do you only do primary residences? I'll answer the second one first because it's simpler. Yes, we only do primary residences because our risk model is that the tenant basically is living in the home. That significantly reduces the risk model like I talked about versus like a traditional landlord-tenant property. So we only do that, and the demand is overwhelming, and that's kind of what we want to focus on. And this is as good of a rental investment that you would basically get doing it yourself, or I would argue even better. So for the first question is, like, how long does it take to pay off? So this is a little bit of a tricky question because it's not like a traditional mortgage where they take a purchase price, they times it by an interest rate, they divide it by 30 years, and then you get basically like a mortgage payment. You can pay it off as quickly as 3 years, right? So you can pay it off like year 1, you can buy 10%, year 2, you can buy 10%, year 3, you can buy us out completely, or continue basically at the 10% every year. So it could be as soon as 3, maybe 10, maybe further. One other interesting thing about our model is that we actually don't force people to buy equity. They have a choice if they want to buy equity or not. So we wanted to make it as clean as possible, as not make it like we wanted to make it like as completely separate from like the traditional mortgage system where you're almost buying equity, but you're buying like 5% of equity and 95% of your payment is basically interest, right? So you're not obligated to purchase equity, but you can.
Another question from online is, does the rent go up with the market rent values every year?
Yeah, so the question is, does the rent go up with market values? Yes, the rent can go up or down, depending on the market values. But both on the rent and the home price, we cap it that it cannot go up by more than 5% a year. So let's say it was a 100,000 house, it went to 107,000. You can buy it from us at 105,000. We want to make sure, like the whole point of this is so that the homeowner can own the home completely, and that's what that does. And there's no, from a Sharia perspective, we cannot have a downside cap. So if it goes from 100,000 to 90,000, we will participate in that.
So, I just have a question. So, if you could walk us through like an example, exactly how it's going to look. For instance, if you invest into 10% company, the average house costs around $390,000 to $350,000, right? So you have that section between rent and also equity buyout. If you can walk us through that a little detail, because I'm a little confused still. Just like
yeah. So I don't think I have a page here, but let's walk through a simple example. So let's say that let's say that the house is $500,000, right? And you put 20% down. So you put $100,000 down. Your rent will be whatever the market rent is. Doesn't matter what the interest rate is, doesn't matter the amount, It will be whatever the market rent is for that house. Just for using easy math, let's say, I know it's probably not comparable, but let's just say it was $5,000, the rent, right? High for Atlanta, but let's just use that. So the rent that you'll pay is 80% of that, because you already own 20% of the house, so you're paying 80%, right? So you pay $4,000 to Nia, that's the rent, and then you own 20% of the house, so you pay 20% insurance, 20% taxes, 20% like major expenses. Nia will pay 80% expenses, 80% insurance, whatever. And then what happens is so that's the only minimum payment required. You don't have to actually buy any additional equity. Now let's say the property goes from, just making it up, 500K to 520K. And someone wants to buy 10%. So they're gonna buy $50,000 of equity for $52,000 of equity, right? Because 520 times 10%. So that $2,000 is the realized appreciation for the investors, and then the remaining is basically the principal. So now after they made that purchase, their ownership, let's say, goes to 25%. Let's say the rent was the same. Their rent is actually going to go down slightly, but their insurance and taxes obligation is going to go up.
So in simple layman terms, if I can break it down.
Yeah.
So the rent is one portion, it's one portion of the equation, correct? And then you also have a payment that is basically buying out percentages of the equity. So rather than 80% in the beginning, let's say first year or third year, it takes away 3% because you're adding to that 4,000, let's say another $1,000. You end up roughly like a $5,000 payment.
Yeah, that's right.
So in simple terms, technically, what the banks would do is with the interest payment, where you have the principal and the interest, you do here differently with rent, and you add to the equity buyout. Is that correct?
Yeah, if I don't like to use this comparison, but if you look at a standard mortgage payment, it's about 98% interest, like 2% equity. You could say that the interest is kind of like rent in this portion, right? The major difference is that on top of that, we're participating in expenses forever that we own and the risk, right? Like if it goes down in value, we'll only take whatever the down value is. If it goes up, we're going to participate in that upside too. But yes, relatively speaking. And sometimes people get confused of like, oh, you have to pay more for equity. Well, no, like if you were to just compare it, like the rent would just be like the interest payment in a mortgage. We're just not forcing people to do that because maybe you can afford this year, but maybe next year you cannot, right? So we want to give that flexibility.
Lastly, what are the maximum durations that you offer? For instance, banks now, they talk about 50-year loans, right? Which is insane. What is the maximum rate that NIA, for instance, can hold a certain type of interest for? Say the 10 years, the 15, the 20.
Yeah, so the question is like the range of the time frame. So when we started the company, we just set it at 15 years co-ownership period, but we can extend it beyond that. It was just, we didn't want to overcommit right now, but that's what we set it at. Like I said, it doesn't matter for us actually if you buy more equity or not, because we're still getting rental income for whatever stake basically that we have in the house.
So in the same example, you have $5,000 a month, and at the end of the year mark, you paid roughly $60,000. That $60,000 that the tenant, that the co-owner is contributing, is that also going towards equity?
No.
So that's just rent. But then at the end, you have the option to buy with another, let's say, $60,000 equity.
Yeah, that's correct, but I'll just, one clarification. You're technically not paying $5,000 rent. You're only paying for the $4,000, right? Number one. Number two, you can still buy every month. So we have some homeowners who like add another $500 every month, just like a regular mortgage. But it's only going to be assessed once a year on the anniversary date. To my surprise, most homeowners actually like at the end of the year or when they get a bonus, they just make a one-time big chunk equity payment, and then they the following year. But you either have the option to do it either monthly or at a one-time purchase. Yeah. The minimum down is 20%. Yeah.
Oh yeah, and then so technically, if a person just never bought more equity than 20% at the beginning, they can just keep renting forever.
That's right, yeah. The question is, like, if they never bought more equity, they could rent forever? Yeah, yes, yeah, that's right.
Two questions, and you can answer the second one first possibly, because I think it relates. In 2020 and 2021, the Atlanta market saw appreciation of home values as much as 25% per year, and in some areas, with this model, if a person's home appreciated 40% in 2 years, and they want to buy you out, would they be paying the appreciated value?
So they're capped at that the property value won't go up by more than 5%, right? So even if it goes up by 20%, we will be obligated to sell it to them at no more than above the 5% basically. And there's no downside cap.
I want to think about what you asked. So like you asked when you pay the rent, for example, 5,000, 12 months, that is 60,000, right? It's not actually reducing the equity, the principal amount that the investor also how is it?
Yeah, so the rent portion does not increase your equity. It's only for the rent portion. But generally speaking, that should be like lower than like a mortgage payment, right?
How do you actually pay down that home? So how is it?
You make a payment towards the equity of the house. So you can either do it by adding like $500 every month or whatever. So that would be at, that small portion, and you would be slowly building equity from like 20 to 21%. Or you can just buy a big chunk at one time, like up to 10% basically a year, right? But generally speaking, that rent will be lower than like a mortgage payment basically. Yeah.
I'm assuming, but correct me if I'm wrong, if somebody wants to buy a rental property, not the home to live for themselves, is there anything near the model to work for that?
Yeah, there's no model to work for that because our payment will be the rent, right? So on the other side of this equation is we have investors. The rent that the homeowner is paying, that's being distributed to the investors on a quarterly basis, and they're getting the part of the appreciation basically. Yeah.
And what is the investment process? Is there a minimum that person can invest with you all?
Yeah. So the investment process is they have to be something called an accredited investor. It's like it's by the SEC rules, which is you have to make at least 200K as an individual or 300K as a couple, and then there's a 50K minimum. But that's flexible. But the accredited investor is SEC rules. The investment is going to the entire pool of the home. So we have 50 today. It's spread across, diversified across 17 different states. And then we distribute on a quarterly basis. So that rental income that the people are paying, minus whatever our obligations for insurance, taxes is, the net of that gets pretty much distributed to the investors. And if someone is buying that equity piece like we talked about and there's some appreciation, that's also going to be distributed to the investors. Yes?
So, how does your model compare and contrast with much of the quote-unquote Islamic or Sharia compliant models that we have with other home financing? Because, there have been critiques of those that look, they are not that different from the conventional ribawi-based models. How, in what fundamental ways does NIA differ from these models?
Yeah. I think there's a few core ways, but the first way that I'll address is that our model is not a loan. Actually, from an Islamic perspective, you actually cannot have any loan besides like fi sabilillah. You cannot, because you cannot charge a premium on a loan, right? From an Islamic perspective. So one is we don't have a loan. We don't have a mortgage concept. There's no lien on the house. The conventional models or any of the existing models that exist today, they give you a mortgage. It's tied to an interest rate. They might call it profit rate, but it's basically tied to an interest rate. They have a loan. They have a lien basically on your house, right? So if you get a loan from one of these banks, your name is only on the deed, but you will have a lien on the house. In our model, there's no lien, but we're both on the title. It'll say homeowner and NIA Fund 1, basically LLC. That's like our fund name, right? And if you own 20%, it'll be 20% you and 80% NIA, for example, right? So that's a very important distinction, because in a loan concept, you always will have to pay whatever amount is left on the loan balance, regardless of if the property goes up or down. In our model, we're equity partners. It's like me and you decided to buy a home together. It went up, it went down, doesn't matter. That's what we're going to participate in, whether it's down or up, right? So that is the fundamental difference, is that it's not we are not a mortgage, number one, right? And because of that, all of the downstream effects of that are different. So that means that we can share in profit and loss. That means we participate in all the major expenses, in taxes, insurance, roof, HVAC, like all of those major expenses. So that is the core thing that differs, and they will never be able to provide that because they are loans that eventually get packaged up and sold to Freddie Mae, Fannie Mac. And our capital source is investors who seek to get rental income and diversification, and they're getting income from that, and we don't need to sell to like Freddie Mae, Fannie Mac in order to do that.
Question from online. Can institutions like Masajid be an investor?
Yeah, they can be an investor. There's some special rules, but yes, you can, yeah. Yeah, so the question is, what's the reason for such a high number of the wait list? So we publicly launched the company about 2 years ago, and last year we bought about 30 homes. This year our goal is to get to about 100 homes. We started the year at probably like 40. So we're actually like doubling on a yearly basis. There's some things that we need to do from a company perspective of like build like a system, like we need a resident portal, we need stuff like that. But the main constraint is basically capital, right? So that relies, like any other mortgage system, they go and sell to Freddie Mae, Fannie Mae, that's their capital source. It's basically an unlimited supply of capital. For us, we rely on the community for basically investing in the company, in the fund. They are getting rental income out of that, basically, right? So I would say that we're growing. We might not be growing at the level of demand that we have, but we are expected to double this year, inshallah, if things go well. And we have to keep doing that, basically, and you know, spreading the word and through these events in order to do that. But it will always somewhat be capital constrained because we can't just print money like the existing systems does, right? It relies on actual people putting their capital. But our goal is to get it into a time frame of like maybe under 6 months or something like that. You should be able to put your name on a wait list and basically buy a home, inshallah.
So, for investors, whether individual or organizations, are your investors all American-based investors? Do you have investors from outside?
They're all American-based investors, yeah.
Are you open to having foreign investors from outside?
Like right now, technically, we're not legally structured to do so. We could potentially, but right now it's just U.S. investors, yeah. Yeah, the question is, can you take our existing mortgage? Yes, we can. We call like refinance, or we call it unmortgage. We've done that about 4 or 5 times now. So yes, that is something that we can do. There's no maximum value of the house, but there is a maximum amount that we can invest. That's about 400K. Yeah.
How do you manage risk for investor? I mean, zero trader, yield straight, open door. Real estate is so hard.
Very good question.
How do you give cash while you're growing? How do you balance that?
That's a good question. So we manage risk in a few ways. So let me talk about at the market level, then I'll talk about at the home level. One is that the housing market in the U.S. is moving kind of in a very bifurcated model since COVID. Before COVID, the housing prices kind of moved all in unison with like where the interest rates basically were. Now what you see is, which is why we watch housing inventory numbers, because that's often a precursor for where supply and demand is, where there's a gap, right? So I was mentioning Chicago, Boston, New Jersey. The Northeast generally is very supply constrained. Those house prices are going up, right? Versus Dallas and Denver, they're kind of flat. So we stopped buying, even though we have probably 1,000 people on our wait list from Dallas, we stopped buying in Dallas about 6 months ago. We might buy one or two, but relatively speaking, it's a very low priority for us, and we're trying to in other areas. So one is we have capital risk because we will participate in the gain or the loss, right, of the house. So we have to manage that, and we do that by looking at the housing data. And the more diversified we are, the better for us, right? So that's why I said that we're in 17 different states, and the more homes that we have, the more diversified that we are as well. So even if one thing happens with one roof, it's not that big of a deal because we have 50 other houses. So that's kind of from a market perspective. From an individual home perspective, it's kind of what I talked about. Our model compared to a traditional landlord-resident model is that there is no tenant turnover. There's no cost kind of associated with that, and that significantly reduces the risk of default or cost basically associated with the tenant turnover. So we've had nobody like miss their rent payment so far out of 50 homes. I can tell you when I had 100 homes managing that, like it was probably like 15% basically. So the risks are significantly less in our model, and the more diversified that we are generally, the better it is.
Quick question. Just to get this clear, is if I buy a house for 500, the investor are 80%. So for $4,000 rent goes to the investor, correct?
Correct.
That doesn't increase my equity on the house.
That's right.
The only way I can increase it is if I increase my percentage.
Yes.
Okay.
Go ahead.
According to which calculation, how is that I understand that the market rate, is that based upon the size and the room for the house, or based on average?
Yeah. So the question is like, how is the rent determined? So I think I mentioned this earlier. The government actually publishes something called fair market rent. It's part of HUD, Housing and Development. So they publish in a particular zip code for like these many bedrooms how much the average rent is. So that's what we use, and then we have a secondary source if needed, that if it feels off, but that's what we use. And same thing that we do on the value of the home. The government also publishes something called Housing Pricing Index. Every metropolitan area of where the house prices went last year compared to the previous year, that's what we use for that. Yeah.
Okay, so let's say I'm buying a $1 million home. You said, I just want to make that understood correctly. Are you saying that the maximum that NIA will put is 400, or that's the minimum?
Maximum that NIA will put is 400. Yeah.
And then, if I am thinking to invest with NIA, and I'm making, and I want to sign up on the wait list, for example. I know you said you have a 3,000 person wait list, but realistically, what's that? Do you know what the time frame kind of is like? If I were to sign up, and then let's say, for example, I sign up now, but I'm not ready to buy a home until 5 years, or
Yeah.
if my turn comes around and I'm not ready yet, do I go to the back of the queue, or do I just get pushed to the next quarter?
Yeah. So we, where is it? Where did I put it? We have three ways to prioritize, three metrics. This is old, but less than 400K from our side, right? We talked about that. In a key expansion market, Atlanta is generally an expansion key market for us. And if you're an investor, if you were to like meet all three of these criteria, we're prioritizing people as early as like 6 months from now, basically. If you're the first two, you're probably looking at like mid to late next year, let's say, basically. Now, what we do is we bucket people on a quarterly basis. So right now, we're deciding the people. Right now, we've already kicked off, given the green light for people for Q2, for example, right? We tell them usually 2 months in advance, hey, your turn is coming up, get ready, start looking for houses. Here's your letter from NIA and stuff like that to go start making offers. By the way, you're also making cash offers, so you can sometimes get a better deal compared to other people. But if you can't necessarily make it in that quarter, you just let us know and we can kick you down the line. But yeah, if you're an investor, you get to choose basically what time period that you want to go in.
Okay, and then what was the minimum investor? By comment, was it 20?
It's 50K, but for this purpose, we have something called a Home Ready program, which is for prioritizing residents, and it's 25K. Yeah.
I want to confirm that the minimum you require of someone purchasing is 20% down.
Yes, that's right.
What percentage of portfolio you think of that portfolio investor should invest in this? Because real estate is risk. Everything is risky. And at a certain age, what percentage is it?
Yes. So give me 1 second. It's one of the. I think I have a slide here. It's one of the most biggest issues that I think that we face as a community is generally our community is very exposed to stocks, and we don't have the option of purchasing bonds. And if you're to look at a standard portfolio, as you start to reach retirement, you probably even have 50% in bonds, for example. So I want to show you one slide deck. This is another webinar that I do about personal finance, and it has this table over here. So I actually updated this recently, but it's not here. But if you're kind of in a growth horizon, you would probably be about 90% in stocks, plus or minus 10%. If you're kind of in a transitionatory phase, like you're getting closer to retirement, you're probably in the middle column. And then if you're almost ready in retirement and you want to move towards an income-based mode, which I find that most people, regardless of how much money that they have, they don't want to sell their assets. They kind of want to receive some income and stability. You're going to be in the right column, right? So there's no real good fixed income option. There's something called Sukuk, which has a lot of international exposure. I don't generally recommend it. But you would kind of be in, at a minimum, I would say around 5%, and it could be something as most as 50%, basically. Now, generally, people are getting older, so I would ignore the time horizon label, but I would call it more from a growth, transition, or income-based of your of where you are. I can, I'll give everybody my email. After, if you want to email me, I can even send you this slide deck. Yes. For the investors, we target 5% rental income and 2 to 3% appreciation. So, 7 to 8, which is pretty standard for any unlevered real estate that you would buy. Yeah. Any other questions? No? All right, I'll share my contact info over here if you'd like to reach me. It's safir@nia.com, and I can share either this slide deck or the one that I showed before. But Jazakallah khair for joining me, and thank you for all the great questions, and I hope inshallah it was beneficial. Yes, go ahead. Just email me at safir@nia.com, SAFEER@nia.com, and I can email you the slide deck, or if you have any other questions, or if you're interested on the investing side, I'm happy to talk to you about that as well. All right, Jazakallah khair. Assalamu alaikum.
Jazakumullah khairan to our brother Safir, coming to us all the way from California. So, mashallah, you can imagine the red eye he took to get here. We're really grateful, alhamdulillah. I think when you saw a flyer about Islamic finance, I think sometimes it's easy to get, or it's hard to get excited. But then when you hear how transformational this could be for our community, especially if you saw that difference in the graph between home ownership for Muslims versus non-Muslims, we just, as a community, feel like we don't have opportunities available to us. And alhamdulillah, people like Safir are working to make that accessible for all of us. So we're very, very grateful that he's with us tonight. So please, greet him on his way out, inshallah. And if you think that there are other people who would benefit from a presentation like this, Safir's actually going to do another session at the Hub tomorrow at, is it 3 p.m.? I have to double check. I think it's at 3 p.m. And he's going to be at ECIC tomorrow after Maghrib as well. So your family members who couldn't make it here, tell them to go 20 minutes in the opposite direction and catch that session, because I do think that this is a great opportunity. We say Jazakumullah khairan again to Safir. Please note that there is still baladi for your enjoyment outside. Don't choose to enjoy it 1 minute before Isha Qama, which is at 9:50. So go enjoy your refreshments. Safir, will you be around for a couple minutes for people to come? Yeah, he'll be around for a couple minutes. Brothers, sisters, equally, don't fight. Everyone can get a turn to talk to Safir. I'm kidding, but inshallah, come up and he'll be here to answer your questions. Barakallahu feekum. Wassalamu alaikum wa rahmatullah.